This topic is presented by Land Investors R Us. Are you ready to file your 2020 income taxes? In our previous video of this series, we explained the difference between the standard deduction and itemized deductions. We also explained each section of Schedule A where you have to file your itemized deductions. In today's video, we will explain the above-the-line tax deductions that taxpayers can take, even if they do not itemize deductions. Do not leave money on the table by missing any of these tax deductions that you can take, even if you do not itemize. Above-the-line tax deductions. In addition to the standard deduction and itemized deductions, we also have the above-the-line deductions. Taxpayers can take these tax deductions, even if they do not itemize. These deductions help taxpayers lower their adjusted gross income, their taxable income, their tax liability, and as a result, taxpayers may qualify for certain tax credits. Taxpayers may claim the above-the-line tax deductions filing Schedule 1 with their Form 1040 IRA deduction. Taxpayers who have earned income, regardless of how much they earn, qualify for an IRA deduction if they contribute up to $6,000 in 2020, and those who are age 50 or older can contribute an additional $1,000 catch-up amount. The deadline to make a contribution for IRAs to be deductible is still April 15th. They do not need to itemize to deduct that income from their taxes, since this is an above-the-line deduction, which means they can claim it, even if they use the standard deduction. If making a contribution in 2021, before April 15th, taxpayers must notify plan administrators that the contribution is made for the year 2020. To qualify for this benefit, taxpayer or spouse must have earned income. Earned income includes earnings from a job, non-deductible combat pay for U.S. Armed Forces, net earnings from self-employment for those who are self-employed, and, for IRA purposes, alimony and separate maintenance payments are considered earned income. If taxpayer or spouse are contributing to certain employer-sponsored retirement plans, they lose the ability to deduct their contributions if their income is above certain thresholds. If taxpayers participated in an employer-sponsored plan in 2020, the phase-outs amounts are between $65,000 and $75,000 for modified adjusted gross income, or MAGI, for single taxpayers, $104,000 and $124,000 for those married filing jointly. If only one spouse is participating, the phase-out amounts are between $104,000 and $124,000 for the active participant spouse, and $196,000 and $206,000 for the non-active participant spouse. Health savings account deduction. Those taxpayers who decide to enroll in a high-deductible health insurance plan that are not covered by Medicare and cannot be claimed as dependents in someone else's tax return can qualify for a health savings account. Contributions made by taxpayers to their HSAs can be claimed as above-the-line deductions. Contributions made by their employers may be excluded from gross income. Amounts contributed remain in taxpayers' accounts until they use them. Interests earned on investing those contributions are tax-free. Distributions may be tax-free if they are used to pay for qualified medical expenses. And finally, HSAs are portable, so they move with taxpayers when they change employers. For the year 2020, taxpayers can deduct contributions up to $3,550 if they are single, and $7,100 if they have family insurance coverage. And, for taxpayers who are 55 or older at the end of the year, an extra $1,000 catch-up contribution is available. If taxpayers fund their HSAs from payroll, those will be pre-tax deductions that will not be included when calculating certain payroll taxes such as Social Security and Medicare tax. So, for taxpayers who have $50,000 in taxable income, and contributed $3,550 to their HSAs, will be taxed on $46,450 only. Student loan interest deduction. Taxpayers who paid student loan interest during a given year, for eligible higher education loans, can deduct up to $2,500 in interest, as an above-the-line deduction. The amount of student loan interest taxpayers can deduct gradually phases out for single taxpayers whose MAGI is between $70,000 and $85,000, and $140,000 to $170,000 for a joint return. Educator expense deduction. Classroom supplies, or continuing education course costs incurred by teachers, and some school employees, can also be deducted as above-the-line deductions up to $250. Taxpayers must work at least 900 hours during the tax year for schools other than post-secondary schools to qualify. Self-employment deductions. Self-employed taxpayers, which includes freelancers, independent contractors, and small business owners, can still deduct the 7.65% employer share of their payroll taxes, contributions to eligible self-employed retirement plans for as much as $19,500 in deferred salary, and certain contributions to health insurance paid to provide coverage for your spouse and children who are under 27 at year-end. Alimony deduction. Beginning from January 1, 2019, alimony payments are no longer tax-deductible for the payer or taxable income for the person who receives it, thanks to the Tax Cuts and Jobs Act, so, this above-the-line tax deduction is only good for those who got divorced before this date. Moving expenses for armed forces deduction. As explained before, TCJA changed completely who can claim moving expense deductions on federal tax returns. Previously, if taxpayers moved to a new location for work, they could deduct eligible moving costs, but now, this deduction is only available to qualified members of the armed forces. Again, these above-the-line deductions are available to qualified taxpayers, regardless of whether they itemize or not. Thanks for watching. Please leave your comments below, or email your questions to landinvestorsforlife@gmail.com. If you like the content of this video, please consider subscribing to this channel.